Most people believe that early retirement is only possible if you're making a six-figure salary, inherit wealth, or get lucky in the stock market. But the truth is, you don't need any of that. You don't need millions of dollars today, investment, and you don't need to win the lottery. All it takes is a simple, repeatable strategy and the discipline to stay consistent over time. Imagine being able to retire years, even decades earlier than most people you know, while only setting aside $500 a month. It sounds almost impossible, but the math proves otherwise. The real difference between those who work until they're 70 and those who walk away in their 40s or 50s isn't income. It's mindset, habits, and the ability to put money to work. Today, I'll show you exactly how $500 a month can transform your financial future and give you the freedom to retire early. When people hear the phrase retire early with just $500 a month, the first reaction is usually disbelief. It sounds too small, too insignificant to make a dent in something as massive as retirement. But that's the misconception most people have about building wealth. They think it's about massive sums of money being set aside all at once. In reality, it's about consistency, discipline, and understanding how time multiplies money through compound growth. The reason $500 a month works is because it doesn't just add up. It grows on itself month after month, year after year, until the results are far beyond what you initially contributed. To put this into perspective, let's take a simple example. If you invest $500 a month into an account that averages a 7% return per year, which is in line with historical returns from the stock market after inflation, you'll have over $600,000 after 30 years. Man, that's without ever investing more than $500 each month. Push that out to 35 years, and suddenly that number jumps closer to $1 million. Notice what's happening here. The amount you personally contributed didn't change, investment. But the longer your money had time to grow, the more it snowballed. This is the magic of compound interest, earning interest not only on your original contributions, but also on the interest your money has already made. It's like planting seeds that grow into trees, and then those trees begin to drop seeds that grow into even more trees. Now think about it this way. You don't need to work harder or save larger amounts to benefit. You need to start as soon as possible and stay consistent. If you delay and think, I'll start when I have more money, you rob yourself of the most valuable element in investing, time. Let's say someone waits 10 years before beginning. Even if they double their contributions later, they're often still behind the person who simply started earlier with smaller amounts. That's how powerful compounding is. Investment. Every year you delay can cost you hundreds of thousands of dollars in lost growth. The other element people underestimate is how much that $500 a month really costs you. Think about where your money goes in daily life. For many people, $500 is just the accumulation of little leaks, eating out more often than necessary, upgrading phones every year, paying for subscriptions you rarely use, or financing cars that depreciate the second you drive them off the lot. Redirecting those dollars into investments is not about giving up joy. It's about relocating from short-term consumption to long-term freedom. The truth is, $500 is manageable for most people once they examine their spending habits. And when you understand the payoff down the road, it becomes even easier to justify. Another important mindset shift is to view the $500 not as an expense, but as buying your future freedom. Every contribution is a piece of ownership in your retirement. Instead of paying rent to your landlord or interest to a credit card company, you're paying yourself. Over time, your future self is the one who collects the rent checks, the dividends, the growth, and the profits. Suddenly, that $500 transforms from a burden into an opportunity because it's the ticket to breaking away from the 9-to-5 grind decades earlier than most. And here's where it gets even more interesting. You don't just have to stick with $500 forever. Many people start there, build the habit, and as their income grows, they increase contributions. That accelerates the compounding effect dramatically. But even if you never added a single dollar more, the results are still staggering. The important thing is to commit to the process because the system only works if you stay consistent. Missing months or dipping into the account frequently disrupts the growth and weakens the compounding effect. Treating that $500 as untouchable is the mindset that separates those who retire early from those who constantly feel stuck. The beauty of this approach is that it doesn't require extraordinary intelligence or insider knowledge. You don't need to chase risky investments or time the market. You don't even need to be perfect with money in every area of life. All you need is the discipline to commit to a number that feels manageable and let time do the heavy lifting. The wealthiest investors in the world will tell you the same thing. It's not about trying to outsmart the market. It's about staying in it long enough for compounding to work in your favor. So when you think about retiring early with just $500 a month investment, remember that the money you set aside today is not just money saved. It's time bought back in the future. It's fewer years working in a job you don't love and more years doing what matters to you. Whether that's traveling spending time with family, or pursuing passion projects, the path to early retirement starts with the simple act of committing to consistent contributions. The earlier you begin, the sooner you'll witness the exponential curve of growth take off. That's the true secret to building wealth with modest means, using time and compounding as your greatest allies. When most people hear about living below your means, their minds immediately jump to sacrifice. They picture cutting out every enjoyable thing, living in constant restriction, and saying no to everything that makes life fun. But in reality, living below your means isn't about deprivation. It's about clarity and prioritization. It's about identifying what genuinely adds value to your life and cutting out the excess that doesn't. By doing this, you free up money that can be redirected toward your future freedom. And the beautiful part is, you don't feel like you're missing out. Instead, you start to feel more in control, more intentional, and more purposeful with every dollar. Let's break this down. Everyone has a certain income coming in each month. For many people, investment. Their spending expands right alongside their income. When they make more, they spend more on bigger houses, newer cars, nicer restaurants, or the latest gadgets. This is called lifestyle inflation, and it's the number one reason so many people struggle to save regardless of how much they earn. Living below your means is the antidote to lifestyle inflation. It's choosing not to let your expenses rise every time your income does. Instead, you hold the line, or better yet, you increase the gap between what you earn and what you spend. That gap is the engine that powers your investments and builds your wealth. Now, think about what it actually takes to free up $500 a month. At first, it sounds intimidating, but in practice, it's often just a handful of changes. Cutting back on eating out a few times a week, brewing your coffee at home, negotiating bills like insurance or subscriptions, and in driving a reliable car instead of an expensive one. Each adjustment may save only $50 or $100 on its own, but stack them together and suddenly you're looking at hundreds of dollars in freed up cash flow. The key is not to focus on cutting everything, but to focus on trimming the areas where you get the least return on your money. It's also important to reframe the way you think about expenses. Ask yourself with every purchase, is this something that truly improves my quality of life? Or is it just something I've been conditioned to think I need? Many times, people spend money not because it makes them happy, but because it's what everyone else is doing. The truth is, happiness doesn't come from buying more stuff. It comes from financial security, freedom, and the ability to design a life on your own terms. By living below your means, you're not just cutting costs, you're buying back peace of mind. Another way to make this easier is to automate the process. Instead of waiting until the end of the month to see what's left over, set up an automatic transfer of $500 into your investment account the moment your paycheck arrives. That way, you force yourself to live on what remains. You'd be surprised how quickly you adapt when that money is off limits. This system flips the script. Instead of saving what's left after spending, you spend what's left after saving. That small change makes all the difference because it ensures consistency and prevents you from rationalizing unnecessary expenses. And here's something many people don't realize. Living below your means doesn't lower your quality of life. It often improves it. When you stop chasing every new upgrade, you feel less stress about keeping up appearances. When you reduce debt and keep expenses low, you feel lighter, freer, and more in control. Instead of being trapped by payments and obligations, you have flexibility. You can handle emergencies without panic. You can make choices based on what you want, not what you owe. That's a far better lifestyle than constantly running on the treadmill of debt overspending. It's also worth remembering that living below your means doesn't have to be permanent restriction. The goal is not to cut back forever. It's to create enough breathing room to invest and let those investments grow. As your money compounds and your passive income increases, you'll eventually reach a point where your investments cover your living expenses. At that stage, investment, you can spend more freely because your financial foundation is solid. Ironically, the discipline you practice today creates the abundance you'll enjoy tomorrow. Think of it like training for a marathon. At first, it feels uncomfortable and requires effort. But over time, you build stamina and it becomes second nature. Living below your means works the same way. In the beginning, cutting back may feel challenging, but as you adjust, you stop noticing what you gave up and you start noticing the progress you're making. Watching your investments grow, seeing your savings account rise, investment, and knowing you're moving closer to early retirement becomes more rewarding than any short-term splurge ever could. Ultimately, living below your means is not about punishment. It's about empowerment. It's about choosing financial freedom over temporary gratification. It's about deciding that your future self deserves better than endless bills and obligations. And when you remind yourself that every dollar saved and invested is another step toward retiring years earlier than most people, investment, that $500 a month feels less like a sacrifice and more like an investment in a life of freedom. freedom. When it comes to building wealth and retiring early, a lot of people think the secret lies in chasing high risk opportunities, trying to time the market investment, or looking for that one big win that will change everything overnight. But the truth is, retiring early on just 500s a month doesn't require gambling with your money or relying on luck. It requires a disciplined investment, smart investing strategy that prioritizes consistency and proven methods over speculation. The goal isn't to get rich fast, it's to build steady, reliable wealth that compounds over time and eventually provides you with financial independence. One of the most powerful tools you have as an investor is the stock market. Over the past century, despite crashes, recessions, and global uncertainty, the market has delivered average returns of around 7–10% annually. That's why putting your $500 a month into broad, low-cost index funds is one of the most effective ways to grow your wealth. Index funds spread your money across hundreds or even thousands of companies, reducing risk by not relying on the success of just one stock. Instead of betting on the next big company, you're essentially betting on the economy as a whole to grow over the long run, which history has proven it does. Dividend stocks are another smart investment. These are shares of companies that not only grow in value, but also pay you a portion of their profits in the form of dividends. By reinvesting those dividends back into your portfolio, you accelerate the compounding effect even more. Think about it like this: your investments are working to make money for you, and then that money is also put back to work to make even more money. Over time, those dividends can grow into a reliable stream of passive income, which is exactly what you need to cover expenses once you retire. Real estate is another avenue that can complement your 500 month strategy investment, especially if you're open to diversification. Now, this doesn't mean you have to go out and buy a rental property right away. There are ways to invest in real estate through REITs, real estate investment trusts that allow you to own shares of income, generating properties without the hassle of being a landlord. REITs often pay dividends as well, giving you both growth and income while spreading risk across different properties. For someone contributing a smaller amount each month, this can be a smart way to diversify without needing a huge amount of capital up front. The important thing to remember is that you don't need to take unnecessary risks to see results. A lot of people get caught up chasing trends, whether it's cryptocurrency, penny stocks, or speculative startups. While some people get lucky, most end up losing money because they treat investing like gambling instead of a long-term plan. When you're working with $500 a month, the best strategy is to avoid those distractions and stick to investments with a proven track record of long-term growth. Another principle of smart investing is understanding your risk tolerance and time horizon. If you're younger and have decades before retirement, you can afford to take on more growth-oriented investments since short-term volatility won't matter much in the long run. If you're closer to retirement, you may want to adjust and balance growth with stability, leaning more toward bonds or dividend-paying assets that generate steady income. The beauty of starting with $500 a month early on is that it gives you the flexibility to ride out the ups and downs of the market and still come out ahead over the long term. Automating your investments is another way to make sure you stay on track. By setting up automatic contributions into index funds, dividend stocks, or other vehicles, you eliminate the temptation to time the market or skip a month. The consistency matters more than the exact timing, because over decades, the market smooths itself out. What feels like a high or low point today becomes insignificant compared to the growth curve over 20 or 30 years. It's also worth emphasizing the role of fees in smart investing. High management fees or trading costs can eat away at your returns, especially over decades. That's why low-cost index funds and ETFs are such powerful tools. Even a difference of just 1% in fees can add up to tens of thousands of dollars lost over your investing lifetime. By keeping costs low and focusing on reliable growth, you maximize the impact of every dollar you invest. Finally, smart investing isn't just about the numbers, it's about discipline and mindset. Markets will go up and down, headlines will cause fear, and there will always be someone telling you the sky is falling. But the people who succeed are the ones who stay consistent, avoid emotional decisions, and trust the process. If you panic and sell during downturns, you lock in losses. If you stay the course and keep contributing your $500 every month, history shows you'll come out ahead. In the end, smart investing is about creating a system that works for you, not chasing shortcuts. It's about building a diversified portfolio that grows steadily, generates income, and compounds over time. With just $500 a month, you can create a powerful wealth building machine that not only sets you up for early retirement, but also gives you peace of mind along the way. The strategy isn't complicated. It's simple, proven, and accessible to anyone willing to stay consistent and patient. When most people think of retirement, they picture stopping work completely and living a life of pure leisure. For some, that's the dream. But for others, It's not just about walking away from a job. It's about creating the freedom to choose what to do with your time. That's why designing a retirement lifestyle is just as important as building the financial foundation to support it. Retiring early with $500 a month in investments isn't just about numbers. It's about aligning your financial plan with the life you actually want to live. Without that clarity, even a large nest egg won't guarantee happiness. With it, even a modest plan can create the freedom most people spend their entire lives chasing. The first step is defining what early retirement looks like for you. Does it mean never working again? Or does it mean having the option to only work on projects you care about? Does it mean traveling the world, downsizing to a smaller home, or moving to a lower cost area where your money stretches further? For some, it's about having more time with family. For others, it's about finally pursuing hobbies and passions they've put off for decades. The beauty of building a retirement lifestyle is that there's no one size fits all definition. The only thing that matters is that it reflects your personal values and priorities. When you build your plan around your actual lifestyle goals, you'll often discover you don't need as much money as you thought. Many people assume retirement requires millions of dollars, but in reality, it depends on your expenses. If your lifestyle is simple, if you've eliminated debt, and if you've minimized unnecessary costs, your retirement budget can be surprisingly lean. That's where the $500 a month investment strategy shines. It creates enough of a foundation that, combined with smart lifestyle choices, can give you more freedom than you imagined possible. Another important element is flexibility. Retirement doesn't have to mean all or nothing. You might choose a semi-retired lifestyle where your investments cover the basics and you do part-time or freelance work to cover extras. This approach reduces pressure, gives you social interaction and purpose, and allows your investments to keep growing while you enjoy more free time. Many early retirees discover that they actually want to keep working in some capacity, not because they have to, but because they enjoy it. And that's the key difference in working by choice, not necessity. Your retirement lifestyle also benefits from creating multiple streams of income. That could mean dividends from stocks, rental income, side businesses, or even small passion projects that generate cash flow. By the time you've consistently invested $500 a month for years, your portfolio can begin to generate passive income. Pair that with reduced living expenses and maybe some part-time work you enjoy, investment, and you create a sustainable system that doesn't rely on draining your savings too quickly. Another factor that plays into designing your retirement lifestyle is location. The cost of living varies dramatically depending on where you live. Investment. If you remain in a high-cost city, your retirement budget will need to be higher. But if you relocate to a more affordable area, or even another country, you can stretch your money significantly further. This concept, often called geo-arbitrage, is how many people retire earlier than they thought possible. With the rise of remote work and global mobility, you're no longer tied to one expensive location for the rest of your life. Investment. Health and wellness should also be part of your retirement design. Retiring early only matters if you're healthy enough to enjoy it. By investing not just in your finances, but also in your body and mind, you ensure that the freedom you worked so hard for is spent on experiences, not medical bills. Maintaining an active lifestyle, eating well, and prioritizing mental health are all essential pieces of the retirement puzzle. The emotional side of retirement is just as important as the financial one. Many people don't realize how much of their identity is tied to their careers until they step away. That's why it's crucial to plan not only how you'll afford retirement, but also how you'll fill your days. What passions will you pursue? What skills do you want to develop? Who will you spend time with? Retirement isn't an escape. It's a transition into a new chapter where you finally have control. Without intentional planning, it can feel empty. With a clear vision, it can be the most fulfilling stage of your life. Ultimately, retiring early with $500 a month isn't just about proving the math works. It's about proving the lifestyle works. It's about creating a life where money is no longer the deciding factor in your choices. Instead of asking, can I afford this? You begin asking, do I want this? That shift is powerful because it turns money from a source of stress into a tool for freedom. The real success of this plan is not just in reaching a certain number in your investment account. It's in reaching a point where you control your time, your choices, and your future. Whether that means never working again, starting a small business you love, or simply having the peace of mind that you could walk away from your job tomorrow if you wanted to, the end result is the same freedom. And that's the ultimate goal of retiring early. Not just more years without work, but more years living life on your terms.